Welcome back. Crocs reported earnings last week, and the stock soared over 19% after the report. Given that I am a shareholder and I've covered the stock in the past on this channel, I thought I should provide you with an update. We'll cover why the stock market reacted so positively to the report. I'll give you an updated valuation, and I'll fill you in on where I'm looking to potentially take some profits while keeping a smaller position. To understand why the stock reacted so positively, I think first, we have to understand where sentiment was coming into this report. Sentiment around the company has been very poor, from HeyDude revenues continuing to decline, to North American revenues declining, to tariff uncertainty, to questions about whether Crocs are just a fad, and inventory resets at wholesalers. Going into this report, the company itself had not sounded particularly optimistic in recent earnings releases. When the company reported their second quarter results, they pulled all guidance beyond the third quarter. In that quarter, they also took a large impairment charge against the HeyDude brand. When reporting for the third quarter, the fourth quarter guidance wasn't very good either, as they guided for negative 3% revenue growth for Crocs and a mid 20% decline for HeyDude. So after the stock sold off following the quarter two report, the quarter three report didn't offer much to really help move the stock in a positive direction either. With the quarter four and full year 2025 report, we're finally starting to see some shift in sentiment from management, and the market reacted very positively on Thursday. So let's take a look at the report and some of the specific positive things that are starting to happen for the business. First of all, they reported a double beat, and while they had guided for revenues to be down 8% for quarter four, they were down much less than that. They guided for Crocs brand revenues, which are about 80% of the revenues for the business, to decline by about 3% for quarter four, but Crocs brand revenues actually grew in quarter four, and management noted that they had a stronger than expected holiday quarter in quarter four. As you can see noted down here, we ended 2025 on a strong note with a better than expected holiday quarter. They also had a note about some cost savings in there, and this was from Wall Street Engine. Things of note on the conference call included taking market share in North America for sandals, with brand awareness of sandals still about half that of their clogs. Jibbitz, which are very high margin, are now 8% of sales, and the company has been introducing things like bags and other accessories that are also compatible with Jibbitz. One of the things that it seems like they're trying to do is to sell more products that allow them to be more of a lifestyle brand and not just footwear. So we're starting to see that unfold more for the company, and including Jibbitz as an option with those other accessories is only likely to help Jibbitz sales. International grew 11% in fiscal year 2025, including 30% in China. And in terms of their opportunity to continue to grow internationally and to grow their store counts, they said, "We believe we have significant future growth opportunity internationally. Our average market share in China, India, Japan, Germany, and France represented approximately 1/3 of the market share we have in our established markets. We ended the year with approximately 2,600 Crocs mono-branded stores and kiosks. In 2026, we plan to continue expanding our footprint internationally and see an opportunity to open between 200 and 250 stores, both in our tier one markets and within distributor markets around the world." Finally, management said they expect HeyDude to return to growth in the second half of 2026. They were asked on the call how much of that had to do with the cleanup that took place in 2025. And if you are interested in part of the reply from management, you can pause the video and check that out here. Although if you're really interested, I do recommend that you go check out the full call. So let's talk valuation. The company did guide for the first quarter to see revenue declines of 5.5 to 3.5%. And revenue down approximately 1% to up slightly for the full fiscal year. Now, that said, they did say they expected to deliver EPS growth in fiscal year 2026. Furthermore, the adjusted diluted EPS guidance of $12.88 to $13.35 did not assume any impact of future share repurchases, which is noteworthy because the company repurchased approximately 10% of their outstanding shares in fiscal year 2025. So let's take a look at a DCF and also look at this just in terms of putting a multiple on their 2026 guidance. Here's an updated DCF for fiscal year 2026. I assumed revenue would be just a bit less than flat for fiscal year 2026. I looked at analyst estimates and assumed almost 2% growth in fiscal year 2027, and then I assumed they would only be able to grow the company 1% from that point forward. Now, if they do better than that, they're going to exceed the expectations of this valuation, and the stock is obviously likely worth more than this. I took the adjusted diluted EPS guidance and multiplied the midpoint of that by the number of shares outstanding from the 10K to get a number for net income in fiscal year 2026. And then I went with a net income margin of 16.5% going forward in future years. Of note, they could surpass this net income margin in the future, and I would not be surprised at all. For fiscal year 2026, I assumed the stock-based compensation adjusted free cash flow number you can see here. And then for fiscal year 2027 onward, I assumed a 92% stock-based compensation adjusted free cash flow to net income margin. I calculated a weighted average cost of capital of 11.07%. Here you can see the numbers I used for that. That weighted average cost of capital is my required rate of return. I subtracted the difference between enterprise value and market cap from the terminal value for future cash flows. And all this considered for Crocs, I get a fair value of equity per share of $111.92. Crocs closed February 13th, 2026 at $96.88 per share. So still some margin of safety built in with this valuation. Now, I think that this could be considered conservative, and I don't think that this represents a ceiling for Crocs by any means. But as you can see, even with this valuation, there's still some margin of safety built in here. I will note that if revenue declines further or Crocs do prove to be a fad or other things happen that limit margins or cause other problems for the business, then maybe this valuation isn't so conservative. But based on what I know now, I would lean toward this valuation being fair to conservative. Now let's take a look at this another way. Management guided for $12.88 to $13.35 of adjusted earnings per share in fiscal year 2026, and that included no impact of share buybacks. So let's take the midpoint of that guidance, which is about $13.12 per share. Based on that, the stock closed Friday at around 7.5 times the midpoint of their forward guidance. So if you have some sentiment improvement here, could the market say, all right, this stock is now going to trade at a forward multiple of 10 times earnings? And the midpoint of that guidance at $13.12 gets you to over $130 per share. I think that could make a lot of sense. To give you some perspective, Deckers is still trading at around 16.5 times forward earnings right now, and Crocs is still trading at a lower multiple than many other companies in the footwear industry. If Crocs were to trade at the same forward multiple as Deckers, you're looking at over $200 per share. And on top of that, those EPS numbers could improve if they do better than their guidance or if you get buybacks. This year, I don't expect them to buy back another 10% of the company, but could they buy back 4 to 8% of the company? I mean, I think that makes sense. I think that's realistic. So basically, guys, I'm seeing a lot of opportunity still with this stock, and I think it could go higher. So let's take a look at the chart, and I'll tell you where I'll likely be looking to take some profits. I started buying Crocs in October of 2024, and I bought some in October, November 2024, and then I bought some in November of 2025 at $74.50 a share. I'll likely keep at least those shares I bought at $74.50 as a longer term position in the company. But there is a gap on this chart up to 135.35. You can see this here. And if the stock fills this gap, if I am looking to take some profits, given, I do acknowledge there's fashion risk with this. There is the potential for this to be a fad, for Crocs to go out of favor. I do acknowledge that. I may look to take some profits there. Now, I do like this company. I think that it could be a potential multi-bagger actually with the way they buy their stock back, and the fact that I do believe there's really just about as good of a chance of Crocs being a consumer staple at this point as being a fad. So I'll likely keep, like I said, at least the shares I bought more recently in November of 2025. I might even keep more shares than that, but there's a pretty good chance that I might look to take some profits should we get that move up to 135.35. Thanks so much for watching. If you found this video helpful or informative at all, please click the like button, subscribe, and click the bell to get future notifications. And also leave a comment down below. Let me know what you think about Crocs. Follow me on X at Stock Sale Flyer for more of my regular updates and thoughts on the markets. And watch some of my other videos, including the last one I made on Crocs. Thanks so much. Take care. Bye.